Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, May 26, 2023. I'm David Zarling. I'm here with Ian Beachwagon McMillan. It's great to have you back on. The S&P 500 is currently sitting at 4,200, but you had a well-deserved week off last week, so welcome back.
Thank you.
Do anything fun?
Yeah, just the beach.
Yeah,
Just
it's a good way to do it. Good weather.
Fun. Yep.
I'm sure the family enjoyed it. It's
Kid
good.
had a blast. My wife is pregnant this year, so no beach boozing for her.
Oh,
So a little, unfortunate for her. I will say it doesn't stop me.
that's right. Did she pull you around in the wagon too? That's
No.
probably not allowed. You can't do that but congratulations to you guys. That's awesome. Excited to see the McMillan clan expand. It's
Yeah.
great to hear. So while you were gone, of course, you kind of predicted this on Twitter that we might see S&P move above 4180 while you were gone. It did that, but then quickly reversed that earlier in the week. And now here we are again, right at 4,200, above 4180. But if we're drawing with a crayon rather than a pencil, 4,200 and 4180.
Yeah, same thing. Yeah, tried last Friday. They got shot down pretty quickly on, I guess it kind of continued into Monday, didn't it?
Right.
But yeah, Monday, Tuesday, Wednesday, a little beaten down. And now we're back. So again, Thursday, Friday, completely different tone. And yes, as you said, we are back to, we'll call it 4,200. So really, we've gone nowhere since Monday's open.
Yeah, Monday's open or March of 2022.
Yeah.
Two ways you want to put it. We've talked about this range plenty of times. It's important, right? This is where sellers have shown up in the past, whether it was June of 22, August of 22, you could argue November of 22, right after the breath thrust in January, which maybe people have forgotten about that January of this year, just massive breath thrusts. You had the Whaley breath thrust, you had the breakaway momentum breath thrust, you had 70, first time recording all three, and a little bit of a rug pull in February and early March with banks.
And
the rest of breath.
yeah, breadth was, I definitely think, breadth was, we've said this before, but February had I don't know if it had everything, but most things on a trend followers checklist had been checked. You used the term rug pull. I think that was great. So now we're back there. Actually, we'll say, yeah, for all intents and purposes, we're back at those highs.
But breath is not the same.
Yeah, way less participation. The S&P's up 8% for the year. It's down 2% without those top 7 stocks.
Oh, right.
But it is what it is. Markets continue to be higher. I think you see on an individual name basis, you see, stocks peek their heads out for a breakout and they just don't stick. Do they move higher? That's debatable, but very ugly trends in general.
You said something interesting there. You said S&P, the cap weighted version, up approximately 9% year to date. But if you take out the top 7 or 8, you're flat or down.
Yeah. So it would have been through now, year to date, probably up 9 with today's action. But yeah, you're down without. So yeah, are there other stocks moving higher? David Cox had a good stat this morning. I think there's 240 stocks in the S&P that are negative year to date, and 260, whatever the equivalent of the opposite. 240 that are positive, 260 that are negative. So you continue to see it. You can look at small caps, we can look at micro caps, we can look at equal weighted S&P 500.
And that would be a good example, if you allow me to paint that picture, just using equal weight versus cap weight, right? So cap weight is more towards those larger capped, that gets more weighting. RSP, which is the cap or the equal weighted version of the S&P, is flat year to date, and it's actually down about 10%, just shy of that, around 9% since its February high, whereas the S&P is back to its February level, the cap weighted version. And I think that paints the perfect picture of dispersion. And we're not here to say it's right or wrong. You know, some people will say, well, your star players are performing, and that's appropriate, you know, but rotation is the lifeblood of markets. At some point, you'd like to see some rotation and broadening out, and not such narrowness.
And it's just, unfortunately, you know, we don't get to go back to the dealer and say, I want a new hand.
Right.
I wish, you know, you could, and you see it in other areas. I mean, you can even look at relative relationships and equal weight S&P versus, you know, cap weighted S&P, the S&P we've all known to come and love.
Yeah, we're at lows.
Lowest in that relationship since November 2020.
Yeah.
Yeah, you know, relationships have their counter trends, right? But this has been since, and again, it goes back to you talked about banks beginning of March, the absolute just massive drop off in this relationship. Really, I mean, we haven't seen anything this extreme since March 2020, as far as like volatility of the move, the extremeness of that move of just underperformance in such a strong, right? Because we've had pretty much 2 months, 3 months since the banking thing happened.
Yep.
And you know, lucky for the indices, running to mega cap tech is the safety play, and that's what these things are made of now.
Right. You've got your large cap names, and your point is that the move out of financials in March and even through now, I haven't seen something like that since 2011. It's a big move. It's a once in a decade move, and that markets are fat tails, and that happens. And equal weight versus cap weight, like you said, lowest since 2020 in that relationship, and it's been fast. It's been a fast move. It's gotten really narrow, really fast. You know, there was a chart here shared internally. I should say a table, not a chart. Just going through the annual S&P 500 contribution. So if we think about cap weighted S&P, the 10 largest weights within that during positive performance years, what's the impact of the top 10%? So right now, the S&P 500 up 9% on the year. The top 10 cap weighted positions are responsible for 95% of that return. And
90, that's wild.
It's not something that, I mean, this goes back. I'm trying to find what the oldest year is on here.
To give context for like a 1999.
So
what was it in 1999?
1999, which that's awesome that you bring this up. That's in those peak bubble years, right? 99, 2000, 54%. So the performance of the full year performance in 99 of the S&P cap weighted was about 19%. Over half of that return was the top 10. That's not even close to 95%. So it's wild. It's really narrow. Your pivot to 99 is appropriate just because that would be a really good year to look at to see, right? Because that was another, I got to be careful. I'm not saying we're in a bubble. I don't want to say that. But when you get this narrow, that has some of those characteristics. Now,
it's awesome. I mean, if you can have 9 guys in a lineup and 8 of them are batting sub 150 and 2 of them are batting 600 and just on track to break home run records, you probably still got a ton of runs from that.
Remember the Bash brothers?
Yeah, I mean,
Jose Canseco, Mark McGwire.
And you look at the scoreboard, right? Don't read the box score. Look at the scoreboard. Look at the index, right? And it looks like, hey, these guys, pretty good team. But
and here you got it.
Unless you're watching under the surface, unless you're watching all 162 games, and you're watching
the rest of the lineup.
Yeah, the rest of the lineup.
You have no idea.
You have no idea. You're just looking at like, hey, they're first place in the division. That's clearly they're doing something right. And yeah, they are. I mean, a win is no one is going to sit here as a trend follower. No one's going to sit here and say this trend is fake or that this isn't real, like that it's not happening before our eyes. just know that it continues to get more and more concentrated. The rest of the lineup continues to get worse. And these 2-3 guys in your 2-3-4 holes continue to actually get better. They went from batting 500 to 600 over the last month.
Right.
If you want to put that in context.
They're now putting together one of the best seasons ever put together. They're now getting a poster made, the Bash Brothers. It's okay. We're not here to say you can't win that way. We're just here to point out that the rest of the team isn't participating.
That's how the wins are coming right now.
Right.
And you would like to, right? Everyone would like to tune in and watch all 9 guys in the lineup, at least 6 or 7 of them.
Right.
Start getting on base, start putting, producing. And that, you get it for a couple days out of the Russell. You get it for a couple days out of these guys in the lineup, and then they're 0 for 4, they're 0 for 5. And thankfully, NVIDIA and Apple continue to put up 3-4 run RBIs of their own a game. And it overshadows it.
That's a great point. I mean, the move by NVIDIA this week.
Insane.
It's pretty impressive.
Biggest since, and this is from David Settle, it's the biggest since 2000. It did continue to go for a few more days. In fact, it was March 2000, I believe. Yeah, March 2000, 28% gap. I think this week it was up 30. I think it closed 24. It's the equivalent.
You're just saying the biggest one-day move for NVIDIA itself?
Since March 2000, did continue to go for, I think, 4 more days. It went up another ridiculous amount over those next 3 days.
It added,
that was kind of it. That was it.
In one day, it added as much market cap as Texas Instruments is as itself. Or you could use Intel as another example.
And I think these market cap stories will get wilder and wilder. Like when I'm 60 years old and doing this, the market cap statistics that people will be able to say, because we've heard what the Apple and Microsoft are more than the entire 2000, something like that.
Apple itself. Market cap is larger than the Russell 2000.
You've got 2,000 publicly traded companies. And these are real companies. These are solid companies. They're not junk. These are not penny stocks.
Right. Yes.
These are real companies.
These are not OTC pink slip companies. Well, and you know what? We talked about a little bit about this last week, and Kevin kind of came up. He decided that the next tier would be ultra cap, right? If you've got large cap, mega cap, what's left? You got to have ultra
get
cap.
To within the next decade.
Unless we have a correction.
Unless we have some massive correction, then there's clears. But at some point in our career, in my career at least, there will absolutely be a new category, right? Because we've already created mega cap. There will be something
that wasn't a term before.
10 trillion, you get some new label. And then the new right? Because at that point, we're going to have tons of $1 trillion. We'll probably have $100 trillion companies by that point.
Right.
And that's just the way it works. Because it's math and numbers, and people talk about
and momentum
market caps as if, what do you think's been happening since the day we've had market caps back in the day in the 20s. If you were a large cap, you probably had a market cap of $10 million or something.
Right.
I don't know. I don't hold me to that, but or 100 million. Think about the first stock to ever reach 100 million in market cap. People probably minds exploded.
We can use another sports analogy. I mean, the contracts that are given to athletes continue to increase, right? And that's
get me started on that.
I know the S&P is a momentum index. The bigger cap get bigger and have more impact on the index overall. And some people like to scream that it's one way or the other, meaning that's terrible that it's that narrow. I have no idea, because that narrowness could last for months, years.
We had this starting in 98.
Right. You could go 2 years with this type of scenario, and who knows if it's also this rising rate environment, right? Because we're seeing that as well. If you look at the 2-year yield, which tends to lead the 10 and which tends to lead the 30-year yield, moving higher, if we're on ongoing raising rate environment for the next 20 to 40 years, you could see a nifty 50 environment where the big just keep getting bigger.
Yeah, of stock companies, there's a line, we're not going to get on a fundamental macro, but we worry about companies and raising rates. Well, what are the companies that can withstand no matter what interest levels are at, no matter what levels they have to take debt out at?
Right.
And it's going to be these massive, massive companies.
Yeah, absolutely correct. And you have to be open-minded. It's not just, we for sure think things move higher. We're just saying that the amount of people that might be viewing this as a negative, we just have to be careful because things can last longer than we would anticipate. Like you said, 98 to 2000, that's 2 years. We could have a mania behind AI going on for 2 years. That's a possibility.
Did with crypto for a while.
We did with crypto. We did with metaverse.
And then I wonder, I've wondered about this recently. Do these themes, so you have .com, you move into 5-6 years later, you move into this real estate bubble. Like I wonder, and I guess this gets a little bit into like entropy where like cycles just like through nature get faster. But are these like crypto gets replaced by like they just happen, they're bigger and they happen more often. There's just a new shiny object.
Oh, you mean the pace of innovation?
Yeah.
Right, because isn't there
crypto lasted like 4 years? I would say like 2017. There's going to be someone listening to this. I own Bitcoin in 2013. Okay, congrats. I'm saying as a national obsession, a stock market obsession, an investor obsession. Crypto, I don't know. Maybe you could go back before 2017. But I would say that's when it became like a mainstream. That's when people started talking about it at the Thanksgiving Day table.
Well, and I don't know if you remember this terminology, but there's something called Moore's Law, right? That states the number of transistors on a microchip. So like a semiconductor doubles every 2 years.
Yeah.
So that would fit that cycle of innovation happening faster and faster and faster. And that's definitely possible. Now, I will say they were saying those type of things in the late 90s as well, meaning this time is different, which is always those
sustainable. This is the future of technology. Right. Going to lead us to the.
I've even had really smart people say, this might lead to a 4-day work week, which while we all would love that,
not for me.
It would be more likely that we would just get more done in a 5-day work week, which is called, working efficiency and productivity. And those who can prompt AI to do what it wants, very similar to search. I get it. And a mania, if it's going to be an AI mania, and it's so interesting, right? Because the names that are falling into the AI bucket are old names as well, like Microsoft.
Yeah.
So manias can last. Is that what's happening? No idea. We're just open to the idea that the large can get mega and the mega can become ultra. And when it's momentum based, these things can hide a lot of things that are going on underneath the surface. Do we see rotation? That would be very, very healthy. If at this point,
from a health standpoint,
right?
Not saying you can't run a 5K with lung damage, but
yeah, it's one of those things where like, I think your baseball analogy of the two players is a really good one.
Yeah.
Because you watch that as a fan and you're like, well, this is awesome. But man, if either of the two revert to the mean, we're a little bit in trouble.
Without the rest of the lineup, like, hey, yeah, we're going to go on a 3-month hot streak. We're all going to bat 300 and
right. So it's an awareness.
Keep going. I mean, you can, right? We could be 81 games through the season, and the media could say, "Oh, there's no way this baseball team keeps it up." And we get to 162, and they're still in. I mean, it can go on. It can happen.
Yeah, absolutely. We're not here to say what the market can or can't do. We're just here to say, hey, might be time to be aware that some rotation and broadening out of the market would be actually really, really healthy versus the narrowing that we're seeing. However, I've also remembered years where there's almost zero dispersion. Things are moving in unison. That can revert back into the same. Like, I believe it was 2017. There was a lot of things working in unison.
Yeah.
And then you had dispersion. Now, can you have it? It's this accordion style participation of the market overall. It's like a breathing mechanism.
I like that example. Yeah.
There
can't be amazing all the time.
Can't be amazing. Yeah. And when there's a broadening out, that's great. It would be fantastic if we saw that. I have no idea if we will. And I know the media narrative is all about debt ceiling, rates, China and Taiwan.
My entire career has been filled with the debt ceiling.
Yes. What's interesting is that, I have it on, there are plenty of places that are looking at, okay, what scenario happens if there's a downgrade? And the most recent example we have is 2011. I'll say based anecdotally from that time frame, because I was around funds at that time. The thought process is that treasuries would sell off and stocks would be fine, and the opposite happened. So we don't get to sit here and know what's going to happen if they don't expand the ability to spend money. I could get on a soapbox about that.
Yeah. We're going to have a whole podcast just on
for sure.
That BS.
But so we've got large cap at February highs, equal weight, not so much, small cap near the lows of the range. You mentioned that banks are still no bueno.
Banks. And I don't, again, and when we've used this terminology so much, they don't have to outperform. But holy smokes, these things have got to start doing something. Right. They're an important piece. Until we're down to 5 nationalized banks like China, they're going to be, and I kind of throw transport's in the same, not trying to be, a 1940s trend following Dow theorist, but transport's gotta these are important things. And you look at, I harped on this earlier in the year. Everyone got so excited. About Caterpillar.
Oh, yeah. Yes.
You remember that?
Yep. Because it was breaking to new highs.
It was breaking out in January, February, holding up. And I said, I did it. I gave it in. So, May 08.
It broke to new highs and then failed.
Broke to new highs and then crashed. You had this thing hold up all of the .com bubble until basically the last leg down, May 2002 to basically the second half of that year. And that's the type of things where I'm not saying it can't keep going. A trend is a trend. Price is price, especially at the index level. And when you're beholden to a benchmark, these are your everyday battles, right? But Caterpillar is broken down. You just continue to see this type of stuff, and maybe it fixes itself.
Maybe we get a broadening out.
No one wants it to fix itself more than me. But you got Caterpillar below a flat 200-day now, essentially a flat. I guess you can call rising, but looking back the last 2 years, I'm going to call it flat.
We're still at a critical level when we look at larger measurements like the Russell 3000, like an RUA. Or you look at something like an NYA, the New York Exchange Composite, which looks more like a equal weight S&P, where RUA probably is still being carried by the mega cap names.
NYSE Composite below a flat 200. Yeah.
It's something to be aware of. And I'll go back to, we're not here to tell the market what to do. This can continue on for the foreseeable future. It's just being aware that while the S&P is where it's at, most stocks are not.
Right. That's what people tune in. Even for the people that, I'll turn on CNBC real quick for 5 minutes to see what the market did.
Mm-hmm.
And it's up, and, year to date, it's up, month, all these things, but the health of it, clearly not the most ideal.
And it's interesting because we're having the dollar move higher from here. We're seeing short-term yield moving higher from here. And that was perceived to be a potential headwind for the market. And it actually has been for the majority of stocks. If we're to make a one-to-one analysis, which you can never do with the market. But at the indice level, the cap-weighted level, there's divergence in that relationship, meaning higher rates, seeing tech move higher is not something that had been a relationship characteristic last year and the first part of this year. That has recently changed, potentially could continue.
Yeah.
We'll see. We've covered domestic stocks a little bit. We didn't get into the
what's
sector.
going on overseas?
Yeah, overseas. I mean, if the dollar's moving higher, we've talked in the past that tends to be a headwind for international. We did have a little bit of a breakdown in, let's look at all world stocks minus US. And not all international stocks are the same. We would agree with that. Your Europe versus Japan versus Argentina versus China.
China's brutal.
Yeah, China had a rough week.
Golly. I mean, they're negative year to date, back to basically November. China Asia is just as bad. Yeah, so rough. They've been below, still declining 200-day over in China.
Right.
Golly, I remember that move November through January. A lot of that's been given back. That'll be a headwind for emerging markets.
I think 2 episodes ago, you brought up just, hey, this consolidation out of an area like VEU or even maybe Europe, it's kind of going on a little too long. And we broke down this week, bouncing today, but below important levels. And when you look at a relationship like VEU versus the S&P, so looking at that ratio, which has been in a downtrend for well over a decade, are we building a base? I have no idea. But the downtrend, the long-term downtrend is still intact in that relationship of being more U.S. focused than international focused. And there's going to be spots. I don't want to paint a broad brush that all international is bad. It's interesting to know kind of what some of the stuff that happened in, Greece.
Greece had a good week.
A pretty big base on an absolute basis that goes back to 2015. If you think about 2015 and 2016, what was going on? Right, pigs.
If there's
Portugal,
if there's been a black sheep through my career, Greece might get the award. But hey, that can always change, right?
Because was that for you, Ian? Was that
2010, 2011?
Right, because from that point forward, there was this whole sovereign debt issue.
First ever market letter I write was on pigs. Oh my gosh, memories.
That's a long base from 2015 through now, right? We're going on almost 8 years of a base for Greece, and you don't hear anybody talking about it. And here it is breaking out.
Man, it's breaking out, right? Price is price. That's a gray weekly chart. And wouldn't this be the market environment for its whole new generation? I mean, I totally can see. I wouldn't be surprised if in 20 years, we've got some young person that works at Adaptive and they're talking about, oh my God, I can't believe you guys never owned Greece. And they're like, well, yeah, you weren't around for the absolute,
are you calling for the return of the Roman Empire? So,
no, and I get it, and right, and that would fit with the international. We've had over a decade of underperformance from international. And Greece has absolutely been one of the worst of those.
Right.
I'd put it up there with probably the UK. No offense to the British, but your stock market is abysmal. Wouldn't that be one of the areas that outperform? If international goes into some big multi-year or potentially decade-long trend, I think you see Greece, right? That's your high beta. That's your high beta play there.
Well, you got Argentina still hanging out.
Argentina.
Mexico.
Mexico's holding up. Is it
not the most
the prettiest thing? But,
right.
I heard, someone told me earlier today, and they made a good point, like higher highs and higher lows are still higher highs and higher lows, and they create these divergences, right? And you can look at an RSI, and we all do it, or a MACD, and you get these, these melt ups. And if this, it's just the hand. It's just the hand that flops on the table.
Yep.
And
you can't get so focused on a broad international brush. You got to do the homework and look at each individual area because they're not all the same. And relationships break down all the time, whether it's this tech versus interest rates relationship, or the dollar versus equities as a whole, or you think of like dollar sensitive areas. they don't always have to be 1-to-1 or correlated. They can move from correlation to uncorrelated. This happens all the time. And then when we look at what about long-term credit, like treasuries, you name it?
We've talked a lot about with clients. They read market newsletters. If they went to the Lunch and Learn in April.
Yeah.
In fact, you can still pull up those charts if they're in your email inbox. There were charts with green and red circles on them. Hey, not a lot to do until something here is broken. So broken to the downside, I would say the last couple weeks for long-term treasuries. So that means, rates moving up. Is it a high conviction breakdown? Of course, we're right, rates right back into resistance and bonds right back into support. So
we don't get to be surprised directionally if it stays within that range. It's right at a pivotal point. If you use something like TLT, definitely something, and what is notable is if you take a relationship like aggregate bonds versus the S&P or TLT versus the S&P. The reason why we look at these is that's a risk on off, very simple metric, right? Am I going to own bonds or am I going to own stocks? And here you have TLT breaking down versus the S&P, or if you flip the relationship, S&P breaking out versus TLT, that's risk on behavior, right? You're making an opportunity cost judgment and you're going to own stocks rather than bonds. And that's a risk on characteristic, and that's a good thing. Now, how it plays out over the next 6 months, right? Because we're kind of heading into that. Remember, it was sell in May and walk away. We're heading into I'm not saying that we're recommending. I'm just saying that's the phrase that's used. And here we are heading into the summer, which seasonally has been flat for a pre-election year in the 4-year presidential cycle. And then fall, we pick back up. It would be very notable if we saw rotation and broadening out during the summer. That would be very unique, in my personal opinion, to see it broadening out during the summer. I don't know if that's the likelihood scenario or not, but here we are. Ian, we've kind of bumped up against the end of our time.
Even if you saw broadening out, but indices maybe stay.
Oh, yes. Just rotation.
Something.
These mega caps just cool and move, consolidate, while small caps and stuff catch up, and you wouldn't really see it at the indice level, meaning the opposite would happen. The stuff happening underneath the surface would be good, but the indice level would just be kind of flat. Is that your point?
Yeah. I guess you'd like to see that, and then maybe in Q3, Q4, maybe Q4.
Everybody parties together?
Yeah, or, who knows? Now I feel like I don't want to get down the lane of the road of trying to predict or game plan.
We can only play what's in front of us, and that's we have to sustain trade above 4180 on the S&P. We have to stay above a 200-day moving average. Clients are familiar with this. Those two things have to remain. If we're not going to do that, then the game plan changes. So with that, Ian, we're bumping up against the end of our time. It's awesome that we have a 3-day weekend, right? It's always great to have a break from markets. I know there's people that get all excited about the idea that there could be 24/7 markets. I'm not necessarily a fan, because core value number 5 is that we're a family of families with life outside the office. And so I hope you enjoy your time with family, and also that we all recognize what this weekend and Monday is about, which is remembering the fallen, right? Because the Bible tells us no greater love is this than to lay down one's life for another. And so we have time to remember those that have done such a thing, and it's fantastic. And so I hope everybody listening to this takes that time both to enjoy family, but to also remember the fallen. And so, Ian, great to have you back on again. I look forward to doing this again in a week.
Have a great weekend, everyone.